So far, so good. I'm happy with the attendance. I think we've reached full capacity. Everyone who's supposed to be here is here. We've been receiving a lot of inquiries. More people still want to attend. So I'm very happy with the attendance. Everyone's paying attention. The panelists have been doing a good job. All the speakers are in full attendance. I'm very happy with the attendance so far.
Yeah, sure. So we've obviously had the situation where in the first half of this year it was mainly non-core measures that were a little bit more contained but driving higher. And then during the second quarter, particularly energy and food prices, probably lifted inflation to its likely peak in the second quarter. But what we're seeing right now, energy prices are actually coming down, and we've seen that this week in the August CPI in the US. But food inflation continues to drift higher, and particularly its core inflation in the US is actually surprising to the upside. So there's both kind of services, but also core goods that is not quite moderating as expected right now. I kind of see it as three potential doors. The one door, the most immediate one, is an upfront synchronized recession because of the multitude of shocks that we've just had. That risk remains elevated but is slightly reducing now. The second option, a substantial risk scenario, is that if we don't have a recession right now, there may well be a recession induced by policy measures next year, and that's exactly as you asked about US inflation and Fed tightening. The third option is we may be able to skirt a recession this year and next year and engage in that so-called soft landing without a recession. What that, however, would require is core inflation in the US coming down and the labor market cooling sufficiently in the US without substantial upfront policy action.
The challenge with inflation is that it eats into returns, right? Nominal returns. So we tend to focus a lot on nominal returns instead of real returns. And real returns is essentially nominal returns less your inflation. And so if you have high inflation, unfortunately, then it means your real return is going to be lower. However, given that interest rates have also been rising, there is a silver lining, which is that if you're a defined benefit fund, with high interest rates, essentially the present value of your liabilities come down, right? And so you are able to fund your liabilities, you are able to meet the obligations to members, even for a defined contribution fund, right? Because you will be owning some bonds, and as new bonds get issued at higher rates, you will be able to earn a decent return on those bonds. So there is some silver lining. Yes, of course, some will argue that higher interest rates reduce or slow down economic growth. But I think one does need to fight inflation because, as the Reserve Bank has also said, it tends to hit the hardest your ordinary poor citizens, right? But even with your middle income citizens, so it's a bit of a double whammy, right? So we've got mortgages, and so if interest rates go up, it means our repayments have to go up. But then you also have to deal with inflation, right? So it is a testing period, but importantly also, South Africa has experience with inflation and relatively high interest rates, right? So if you look at what happened during the global financial crisis and after it, where countries like America and Europe were literally sitting at zero interest rates, we haven't experienced that, right? So it is really about navigating the cycles, and I think once you go through every cycle, whether you're an asset manager or a fund, you become better equipped managing some of these shocks.
Right, thanks for the question, Sia. So execution risk refers to the risk of not performing or executing the strategy which you have planned. So it is measured by basically calculating the deviation between your strategic asset allocation and your actual investment portfolio. So in terms of minimizing strategic risk, The governance process involved is that you, as a board of trustees or the asset allocator, would basically oversee the implementation of the investment strategy and basically ensure that the deviation between your actual portfolio and the planned portfolio strategic asset allocation does not differ or exceed the tactical bounds in which have been planned. So it's measured and monitored on a regular basis, and you have regular engagements with the manager to ensure that that risk is managed consistently.
Yeah. So if you look at infrastructure as an asset class, it typically gives you long-dated cash flows that are inflation sensitive and adjusted. And if you match those cash flows with typical pensions that pension funds pay, then they make a nice match in terms of liability, cash flows coming in and cash flows going out. So for any pension fund, infrastructure gives you a nice cash flow generation profile. So as a pension fund, we like that. Now, place that asset class within a South African economy or any economy of any country. It creates jobs, it spurs on the GDP, it creates productivity and improves the competitiveness of the country. So it gives us better growth prospects, which influences our listed space, and we get returns as well. So I think it's a win for a pension fund and it's a win for a country as well. So we greatly support infrastructure as an asset class.
Thanks. Well, the race to net zero has begun. It's begun here in South Africa, but it's also begun internationally. And the first thing that retirement funds need to do in order to progress in terms of their climate ambitions and making sure that we actually don't go beyond that 1.5 degrees global warming risk is they need to commit to managing their climate exposure, and they need to understand the extent of their potential risk. For retirement funds and investors, that risk is most presented through their investment portfolio. And there are numerous tools that are available to investors wanting to understand their portfolio risk from a carbon perspective, carbon emissions perspective. Transition and physical risks present material risks to retirement funds. And so what we would encourage retirement funds to do is to have a policy addressing climate risk, and then to do a baseline assessment. And there are numerous service providers that can support retirement funds with that.
And I can speak for what I'm responsible for, which is the assets that I'm managing on behalf of the GEPF. One of the conversations that I think we are thinking of actually having the GEPF is actually having a venture capital fund. And the whole idea is to do more research, especially because to me, and I think for us as a large investor in South Africa, it's in our best interest to ensure that some of the technologies and the resources that we have are actually continue to be used into the future. For instance, coal for production of electricity. To simply say we can't do it could be short-sighted. So the most important thing is to say, how can we continue to be using coal to produce electricity, but actually control issues like emissions? And that requires new technologies to counteract the emitting characteristics of current power generation technologies.
Well, in our case, we have done it in various ways. One is for what we call making it accessible for renewable energy in rural areas, creating a revolving fund that one of our fund managers is doing. And then the other one is to facilitate bridging finances for those who have obtained tenders and have no security as such. And then the final one is in respect of end-user financing to obtain loans to acquire shelter or houses. So that is how we have addressed the matter.
Sure. So pension funds already invest in private equity and invest in a lot of funds and funds of funds. I think the role that pension funds could do to stimulate innovation and stimulate fintech in multiple countries is to potentially invest in venture capital, because a lot of venture capitals then invest in fintechs and stimulate innovation. So fintech can be used for gender equality in various ways. One of them is financing women-owned businesses. Fintech can be used for that. It can be used for machine learning and alternative credit scoring for women, again, women in rural areas, women farmers, funding women farmers, as well as ultimately, again, funding women-owned businesses, women-owned private equity funds, women-owned venture capital funds, and women-owned businesses?
Look, thank you very much for having me. Pension funds and the muscle they have will have to be used to ensure that transformation happens. Why am I saying this? I'm saying this is possible because South Africa's history is a history that no one wants to be proud of. We have to use the muscle that we have to change. Now, in particular, what I mentioned about the financial sector, in particular banks, it's unfortunate that many white males are in control. Many white males are CEOs, many white males are chief risk officers, many white males are chief financial officers. That cannot be true. It doesn't mean black people cannot do the job. That's what I said yesterday. And I said, not only that, we have to also transform the boards. Who sits in the boards? Who sits in the credit committees in banks? So that we are able to have representativity of everyone who matters in South Africa. But we're saying, as a GEPF, we have that muscle. And I said something very controversial, I'm sorry I have to say it. If those who are not in agreement with us, they'll unfortunately have to fall off the GEPF bus.
We are a young pension scheme. 70% of our membership is less than 30 years. So one of the biggest factors we look at is obviously the environment, making sure that the environment is well kept and therefore adding to the value. The second one is around the social side of things and the creation of employment. Because of the young employment, we see that we've got to do the businesses that will add to employment, but also be able to protect the environment while also adding to the economy and making sure that the economy grows responsibly, but taking care of that growth and bringing the businesses, especially which have a positive impact on not only the economy, but also on the environment.
So venture capital is really what we call early stage funding of entrepreneurs. Those entrepreneurs could be black women, white women, black youth, or any other person. But that early stage funding is usually ideas that are not normally funded by the banks. They are not normally funded by private equity because the size is too small. But we think, somebody said during our session that if you look in Africa, the SMME sector is actually the employer, or the informal sector in Africa makes up potentially 85% of the economy. So for us to formalize some of those industries, we need to back our young people, we need to back our women-led businesses. So I see it as a gap in the market, and I just think as pension funds, as the PIC, we need to look at engaging those markets and try activate it. So at the core of what we do, it's obviously bottom-up fundamental analysis, but also macroeconomic analysis. So for every decision that we make, it's difficult to get the macro forecast correctly, but we believe that if you do your bottom-up fundamental work properly, we have a research team at the PIC that sits outside the listed and the unlisted team that just focuses on understanding trends on a 5, 10-year, 20-year basis. So based on the opportunities that we see that come out of that team, we can take long-term views. On a shorter-term perspective, you have to rely on valuations. So if we look at currently, I would say the bond market in SA at 11%, 11 and a quarter or so, we think it offers a fantastic value, and we are overweight that particular asset class. On the equity side, we are still sort of neutral. Properties, we are also neutral, but with the bias to increase as asset prices have gone down. So at the key, valuations is quite important. Your price into the investment, it's quite an important factor with regards to your total return.